Okay, let's picture this. An absolutely enormous pool of money just sitting there.
We're talking over $7 trillion, right?
Over $7 trillion, yeah. Currently parked in U.S. money market funds.
Which means it's basically in cash equivalents, earning a modest yield.
Right, maybe around 4 or 5%, give or take. It's sort of on hold.
Waiting for something, yeah. Playing it safe.
Exactly, and that's the big question we're diving into today, based on the source material you brought. What happens when this huge pile of capital eventually decides to move?
And crucially, where does it go?
Because the analysis we're looking at suggests it won't just be a slow drip, drip, drip.
No, not likely. History suggests when money moves out of cash like this, it can be more like a surge, a really significant flow.
Triggered by what? Maybe the Fed hinting at rate cuts?
That could definitely be a catalyst.
Yep.
Or just investors deciding they want, better potential returns than cash is offering anymore.
Okay, and here's the interesting angle from the source. Potentially getting ahead of that wave.
Right. Looking at certain types of investments before the big money starts moving en masse.
And the specific suggestion is dividend-paying stocks.
That's what the source points to. Dividend stocks as maybe the first port of call for this cash.
So our mission today,
Yeah.
unpack this. Why does this $7 trillion matter so much now? And which specific dividend stocks does the source think are, well, positioned to benefit?
Let's get into it. That $7 trillion figure, it's genuinely staggering. Historically, very high levels of cash on the sidelines.
And the main reason, as the source notes, is those higher interest rates we've seen. Made earning 4 or 5% on cash feel pretty comfortable.
Exactly. Relatively risk-free during uncertain times, people parked funds there.
But that safety net is also why the source sees it as like a coiled spring.
Yeah. Any shift in the interest rate outlook, or even just sentiment turning back towards growth, that could be the trigger.
Which brings up how investors actually behave. The source looks at past cycles.
And finds that money doesn't just dribble out of cash in these situations. It tends to, surge. A faster move towards perceived opportunities.
Okay, so if there's a potential surge, why dividend stocks first? Why not just pile into, I don't know, high-growth tech or bonds?
Well, some money will go there, absolutely.
Yeah.
But dividend stocks hit a kind of sweet spot, especially for folks moving out of the safety of cash.
How so?
They offer income, right, through the dividend. That replaces some of the yield cash was giving. Plus, you get the potential for growth if the stock price goes up.
So a blend, income and growth potential.
Exactly. It tends to make them less volatile than, say, pure growth stocks. It's a potentially smoother step up the risk ladder from cash, offers income stability, but still gives you that market upside.
Makes sense. So giant cash pool, potential surge, dividend stocks is a likely first stop. Now, the source gets specific. It names 3 companies it thinks are quietly positioned to shine.
Yeah, described as steady, resilient, almost boring in all the best ways, which I kind of like.
Boring can be good in investing.
It really can. Companies offering stable income, maybe some price appreciation, and, as the source puts it, a lot less heartburn than chasing speculative stuff.
And those 3 are Lockheed Martin, AbbVie, and VICI Properties. Let's dig into Lockheed first, LMT.
Okay, Lockheed Martin, aerospace and defense. Current dividend yield is sitting around 2.8%.
Lockheed, fighter jets, missiles, big defense contracts. How does that fit this picture?
Well, as the source points out, defense isn't flashy, maybe, but it's incredibly reliable.
Governments are the main customers.
Exactly. And defense budgets, they get debated, but they tend to be very stable and predictable. Especially now, globally, you see nations boosting military spending.
And the U.S. budget alone is massive.
Huge. Projected over $850 billion for 2025. And Lockheed is a prime recipient. These are massive long-term contracts, a very dependable revenue.
What about the dividend itself, its history?
Very strong. Lockheed's increased its dividend every single year for the past 2 decades.
Wow, 20 years.
Yeah, the source even calls it aristocratic, that kind of consistency. They generate solid earnings, good free cash flow.
Which is the actual cash left over, right? The important stuff for paying dividends.
That's the lifeblood.
Yeah.
And Lockheed uses it well, rewarding shareholders, buying back stock. The source is pretty bullish, calling the dividend as close to bulletproof as it gets.
High praise. Okay, moving on. AbbVie. ABBV.
Right, AbbVie. Healthcare, pharmaceuticals, currently yielding around 3.9%.
Now, AbbVie spun off from Abbott Labs, and I remember the big worry was Humira, their blockbuster drug, going off patent. How did they handle that?
That's a really key point the source makes. AbbVie didn't just, sit back. They've really evolved.
Diversified.
Big time. Built a portfolio through developing new drugs and making some smart acquisitions like Allergan, So they're now big in neuroscience, oncology, immunology, even aesthetics, think Botox.
So not just relying on Humira anymore?
Not at all. New drugs like Skyrizi and Rinvoq are showing explosive growth, according to the source, gives them a much broader, more robust earnings base now.
And how does the market see them now? Has perception caught up?
That's interesting. The source suggests maybe not entirely. Despite that initial panic about Humira, the stock still looks, well, potentially undervalued by some measures.
Like the PE ratio.
Yeah, its forward PE looking at expected earnings is well below its peers, which is kind of odd because AbbVie's actually been outpacing those peers in recent earnings and revenue growth.
So maybe the market hasn't fully priced in their diversification success.
That seems to be the implication. And the dividend track record. Phenomenal.
As good as Lockheed's.
Even longer, technically. 51 straight years of increases if you count its history within Abbott Labs before the spinoff. The source calls AbbVie a top-tier dividend grower.
The holy grail for income investors, right? Getting income and income growth.
Exactly, that compounding effect.
All right, third one, VICI Properties. VCI, that's a REIT. Real Estate Investment Trust. Higher yield here, around 5.5%.
VCI's model is pretty unique, as the source details. They own prime real estate in entertainment, hospitality, gaming.
Like the big names on the Las Vegas Strip?
Yeah, think Caesar's Palace,
Right.
MGM Grand, the Venetian, iconic properties.
Yeah.
But here's the key. VCI doesn't run the casinos or hotels.
For the landlord.
They're the landlord. They own the buildings, the land, and they collect rent from the operators.
And those leases must be pretty solid.
Very solid. Long-term and usually triple net.
Meaning the tenant pays for taxes, maintenance, insurance.
Correct. That shifts those variable costs away from BCI, makes their cash flow very predictable. Plus, this is important now, the leases often have inflation escalators built in.
So rent goes up with inflation.
A hedge.
A built-in hedge, yeah. And they're not just Vegas anymore, are they?
No. The source mentions they've been diversifying. Acquisitions in Canada, partnerships outside pure gaming, like golf courses, strong tenants, solid balance sheet.
So that yield, over 5%, how does the source frame that compared to, say, just holding cash?
Well, it's obviously higher than the 4 or 5% from cash right now. But crucially, it's income that has that inflation protection via the rent bumps, unlike, say, a fixed-rate bond. Right, so the source sees it as particularly attractive in this environment. Good income, plus some defense against rising prices, eroding your purchasing power.
Okay, so we have Lockheed, Defense, AbbVie Pharma, VICI, real estate landlord. Very different businesses on the surface.
Totally different sectors.
But the source says they share some key traits that make them stand out for this specific scenario. Cash potentially moving out of money markets. What are those common threads?
Yeah, the source pulls it together nicely. First, resilience.
Meaning?
They operate in sectors that are, well, fundamentally necessary or desired and not easily disrupted. Defense spending is sticky. Healthcare needs are constant. People want entertainment and experiences.
These aren't fad businesses.
Not at all. Second, they generate significant free cash flow.
We talked about that, the actual cash that fuels the dividends.
Exactly. The source calls it the lifeblood. It's hard to fake cash flow. These companies have it, and they have healthy payout ratios. They're not stretching too thin to pay the dividend. There's room to reinvest or keep growing it.
Makes sense. And the third thing?
Potential for capital appreciation. This is key. The source stresses these aren't just yield traps high dividend. The stock price goes nowhere.
They have growth potential, too.
Yes. Lockheed has potential from new defense contracts. AbbVie from new drug approvals, their pipeline. VICI from smart acquisitions, expanding their property empire. They have catalysts that could drive the stock price higher over time. So you get income and potential growth.
Which brings us back to the timing argument the source makes. Why think about buying now? Why not just wait and see if the $7 trillion actually starts moving?
Because the argument is that money moves fast when it shifts.
The surge idea again?
Right. And dividend stocks like these, offering that blend of income and stability, are seen as logical first stops. They could see prices pushed up pretty quickly as that wall of money looks for a home and equities.
So buying early potentially locks in today's yield.
Which looks pretty good compared to cash, especially if rates do fall.
And gets you in before the herd potentially drives up the price.
Exactly. You benefit from the potential price appreciation that follows.
And then there's the power of reinvesting those dividends.
Huge point. The source really emphasizes this. If you own these early, you can reinvest the dividends to buy more shares.
And if prices are lower now, those dividends buy more shares.
Precisely. And those new shares then start paying you dividends. It creates this, the source calls it an accelerating income snowball. Your income starts generating more income faster and faster over time.
So while holding cash feels safe, the perspective here is that just waiting, kind of hitting snooze on that $7 trillion has a real opportunity cost.
That's really the core message. LMT, ABBV, VCI, they're presented not as get-rich-quick schemes, but as quality companies offering, peace of mind, income, and that potential appreciation.
The three-headed dragon of smart investing, as the source puts it.
A memorable phrase.
So this deep dive really frames the choice for you, the listener. Do you want to be positioned, potentially leading the charge, when that theoretical stampede out of cash happens?
Or are you watching from the sidelines, maybe after prices have moved and yields aren't quite as attractive?
The potential upside of being early, of being strategic before a big market shift, it's definitely something to think about.
Absolutely. Makes you reflect on your own approach, especially with so much capital potentially ready to be redeployed.
Don't wait. Be early. Be smart. Be invested.